Hey guys, welcome back to another video, and today I'm here to talk about an investment strategy that I have and how it yields the great returns that I've been able to see over the past year, all time, and then also along with the past 3 months, year to date, and how it's grown my portfolio to the size it is today from an initial investment of around $15,000. We're up $9,000 in a year, so it's been pretty good. So yeah, if you do enjoy this video, if you learn something from it, be sure to smash the like button for this video. Also subscribe to the channel. I'd really appreciate it. We're almost at 350 subscribers. We're moving very fast. Thank you guys for the support, and let's get right into it. So today, the strategy that we're talking about is one that consists of multiple stocks. We have Amazon. I use this strategy on Google, Cake, SoFi, Celsius, Fubo, Nike. Every stock in my portfolio I've utilized this strategy for. So this strategy is buying. So the strategy is not hard in itself. It's very easy, but you need to be very sure of what you're buying. So the strategy itself is to buy great companies in points of weakness that aren't caused by the company's fundamentals or the company itself. So we have ELF right here. ELF was trading at around $130. You see it was $170. It dropped to around 100. This is when I began buying ELF because it dropped for no reason, in my opinion. I think that ELF was still the same company it was when it was $140 or $170, except it was only worth $100 for some reason. So the share price dropped, and this was due to something that was unrelated in the company, in my opinion. So I think that this was a very good reason to get into the stock, and that I did, and I got into the stock with an average cost of $73 because for a little bit here, ELF was below. It was, what's the 52-week low on this stock? I think they actually went, or the 50, oh yeah, below $50. They're $49 stock. So they dropped a lot. ELF was a very cheap stock. They were lower than $50. And I bought that company because I thought that ELF was the same company they were at $170, except now they were just there for a discount. So that's not to make this strategy seem like you're just buying dips and getting lucky. Because I can see how one would think that. One could definitely, say, oh, you just bought a market dip and you got lucky and it bounced back. Of course it's going to bounce back. That's not true. There's a lot of companies out there that are falling knives that just keep falling lower and lower. Like if we look at, Lululemon, I forgot their ticker symbol. What is it? Yeah, Lulu. We can see Lululemon. Let's look at this company. They're just a falling knife. You couldn't have bought it. Maybe if you bought it and swing traded it from 236 to, 400. But they're just a falling knife because you bought it right here, you held it all throughout here, it's just still falling. This is, a falling knife. I didn't believe in the company there. I still don't believe in the company. That's why I didn't buy it. The price has to be attractive. You need to find a company that's cheap enough with the right fundamentals to the point where you feel confident that you're mitigating your risk to a certain point to where you can invest in the company and, feel no worry. Like when I bought, let's take a look. When I bought SoFi for a price average cost of $8 a share. When I was buying SoFi, I felt no risk. Buying SoFi at, where was it? I think I started buying just like right around here when it was $8, just hovering around this area right here in 2024. I felt no risk in SoFi because if it dropped to $4, I wasn't worried as long as the fundamentals in the company didn't change. I just dollar cost average down. I was fine with that. So you need to invest in stocks that you're going to be in for the long term. And you need to trust their team, their management, their investment strategy, what the company's doing themselves to position themselves in the best way to, profit. It's all about making money at the end of the day. And then them making money makes you money. So really, you are investing in their company. Let's not, blow past what the basis of the stock market is. You are investing in a company, giving them more money, more funding for them to, farther their business, farther their business ventures and money-making goals. And that's really what the stock market is. So you need to start looking at stocks as, they're assets. So stocks, you buy them and you want them to go up, and you need to buy the right company because it depends so much on the company, the space they're in, their management, their team, their growth rates, their balance sheet, everything like that. Their margins, their profit margins are very important. If they're in a competitive space, you need to make sure they have that competitive advantage. But yeah, there's so many companies that drop when they have good fundamentals, and they're dropping for reasons that are beknownst to anyone, like Celsius right here, their growth rates did slow down, but this is just believing in the company, the management team, and what they have going on. So I bought Celsius for an average price of around $27 a share. I was picking it up around right here. They dropped all the way to 22. I wasn't worried. I dollar cost averaged down, and now they're around $50 a share. So it's not over. I mean, they still have a lot of space to go up or go down. There's a lot that can happen with Celsius, but we see that it was a pretty good time as of right now. It looks like probably a good investment. But there's so many companies like this, and then if you don't want to go the route of buying SoFi or Celsius or companies like that, Elf, that are kind of not as established maybe as Amazon or Google, then you can buy the Amazons and the Googles of the stock market. Because if we look right here, Amazon had a big point of weakness right here, $167. Is Amazon going to the ground? No. I mean, Amazon runs the world basically. You know what I mean? I mean, it would be insane if Amazon just dropped and they went all the way down to $100. Everyone that was smart would be picking up shares, and that's the thing. You need to. Every bad investor's favorite quote is Warren Buffett saying, "Be greedy when others are fearful," because they want to buy a falling knife. But this is true in this case. If the stock is very cheap, then buy it. If it's cheap and you believe in the company and their fundamentals, then buy the stock. Like right here, Amazon stock was very cheap in my opinion. It was $167. I got in. I dollar cost average up since then, but I was in Amazon for $167, and I was happy with that. I was like, or I probably started buying it around here anyways, around 200, and then I dollar cost average down. It dropped to 190, and then it dropped all the way to 170, and then 160. But I was never worried that I was going to lose my money because I believe in Amazon as a company. I believe in their management team. I think that everything they're doing is great. Their PE ratio was relatively low considering the space they're in. And so I felt very confident in that investment. And then if we take a look over at Google, which I own, around $500 in, not as much as I want to, definitely want to build out this position to be at least 10% of my portfolio pretty soon here. But this is a live action of a stock that I think you have no risk investing in because you can dollar cost average down if they drop, and this is a safe bet in my opinion. I think this is some easy money to, outpace the S&P. So this company has a 21 price to earnings ratio, which in this space is very low. This is, they should be 1.5 times that at least, I think, in the 30s, the low 30s, if anything, because of the competitive advantage they have over other companies. This should be a more richly valued stock. But this is a company that if you bought it right here, then you're a little bit better off. I mean, obviously, 147, it's at 200 now. But I bought it for 191. If we look right here, it's not a point of weakness, but this company is just cheap. I mean, if you look at the fundamentals, what the competitive advantage they have in the market, they're very, very established, Google, but all their assets and facets of their business that they have are very promising. I mean, the things that they're doing with this company are very, I really like it. I really like what this company has going on. So especially Waymo. I've made a lot of videos talking about Waymo, but Waymo is very, very promising in my opinion. I think that's going to yield them a lot of money. But we see Google rose 21% in the past year, 170% in the past 5 years. So this is a company that's established. They're in the Mag 7. There's a lot of Mag 7 companies. Not all of them, do as well as others. But we can look at Microsoft as well. This is a company that has a PE ratio of almost 40, very similar space as Google, but Microsoft can't seem to go down. This is another company up 150%. And then Amazon also has a higher PE ratio than Google. And I think they're in similar spaces. They should both have higher PEs. I think Amazon's relatively cheap right now too, around this $220 mark. This is, a pretty high valuation for the company because considering their all-time price. But at the same time, if you said that same thing right here and you were like, oh, I'm going to wait for Amazon to drop, I'm not going to buy it, then it would have gone from 170 to 237 pretty fast. So you can't, try to time the stock market, but if a stock does drop, you got to base it mostly on their balance sheet. If the stock is cheap, then, you want to get into it. But if it's a great stock that's cheap, that's great. But yeah, the thing is that you're not going to get into that every single time. So we see that right there. But I wanted to check out the investment calculator. So let's say you start with $10,000, you're saving up for a year or so, 2 years. And let's see your return rate after 10 years. If you do the strategy, I think you can pretty easily yield 20% a year. And let's say you have a minimum wage job, you're working 40 hours a week, you're making, 40 hours a week, minimum wage, you're making $20 an hour. We'll say, what are you making? $800 a week, and then that's 4 times a month pre-tax, that's $3,200. And let's say you don't have any living expenses. Let's just say you're making $1,000, or you can afford to invest $1,000 a month. we'll say 500. We'll just make it simple. But if you do the strategy and you invest that 500 on this 20%, that's 234,000 after 10 years from starting with 10,000 and investing 500. And then if you run this strategy for 20 years, that 234,000, oh, did not mean to put 1,000 20 years. That would be that's a big number. But we see you get to the million. So if you run the strategy, you can get to $1 million pretty, I mean, 20 years is a long time. But if you're working a minimum wage job and you have $1.6 million in your bank account, that's not too shabby. And that's not to say that this strategy can completely overtake investing in, a ETF. I think that, buying an ETF like VOO or SCHG, one I've covered in other videos, is definitely the way to go. I'd base most of my portfolio around that. But if you base, 50% of your portfolio, put it in the S&P, put it in an ETF that you believe in, do that for 50% of your portfolio, and then the other 50% invest in single stocks. I don't not like that strategy. I think that gives you some safeness that you're going to make 10% a year on that. And then I think you should make the 20% a year on the other stuff, which will come out to, about, you're making 15% on your portfolio. So I think that that's a safer way to go. And if you can do that for, let's say, 40 years, that's your retirement goal. That's $14 million. So to run this strategy, you do need to be kind of involved in the stock market. You need to know what stocks are doing good. You need to read balance sheets. You need to enjoy it, which I do. But if you don't enjoy it, then just invest in an ETF and make a safe 10% a year. That's not a bad way to go about it either. But yeah, that's all I have for today's video. I just wanted to give you guys the strategy that's yielded me a good amount. And I mean, it's easy to say that I got lucky and invested at the right time, but there's a lot of stocks I could have invested in and not made the same returns, the same, figure. So if you did enjoy this video, be sure to like it. Also subscribe to the channel. I really appreciate you guys for watching. I'll catch you in the next one tomorrow. Peace.